Hello and welcome to the parallel economy, where traditional finance meets the new world of decentralization. We explored how money, power, and trust are being rewritten in real time. Please remember, this video is for educational purposes only and does not constitute financial or investment advice. Always do your own research before making any financial decisions. Now, let us explore one of the most fascinating experiments in modern finance. A digital bridge between two worlds that could redefine what stability really means. Every economic system begins with a single promise: stability. People want money that holds its value, that can be trusted tomorrow as much as today. But history has shown that no currency remains stable forever. Gold was too heavy to carry around. Paper money could be printed endlessly, eroding its value. And cryptocurrencies, while innovative, introduced a brand new problem: extreme volatility. Bitcoin could rise or fall 10% in a single day. That made it revolutionary, but not very practical for buying your morning coffee. So, developers ask a new question: what if we could create digital money that moved at the speed of crypto but held the stability of the dollar? The answer came in the form of stablecoins. Digital tokens designed to maintain a fixed value, usually pegged 1-to-1 with a national currency like the US dollar. The idea was that one token would always equal $1. The goal was simple: merge the reliability of traditional money with the incredible efficiency of blockchain technology. Imagine a system where you could send funds anywhere in the world, instantly and cheaply, without ever worrying about wild price swings. Stablecoins became the essential bridge between the old world of traditional finance and the new frontier of decentralized finance, a link between human trust and computer code. So, how do stablecoins actually stay stable? Well, there are several different approaches. The most common are fiat-backed stablecoins like USDT, also known as Tether, and USDC from Circle. These hold actual dollars or short-term government bonds in a reserve. For every digital token in circulation, there's a corresponding real-world asset locked away, backing its value. Then you have crypto-backed stablecoins, like DAI from MakerDAO. These are a bit more complex. They maintain their value by holding in excess of other cryptocurrencies like Ethereum locked inside automated smart contracts. This over-collateralization acts as a buffer against price drops. Finally, there are algorithmic stablecoins. These try to hold their peg using automated rules that adjust the token supply based on demand expanding when the price rises and contracting when it falls. In theory, it's a beautiful system, but in practice, this model has led to some spectacular failures, like the infamous collapse of TerraUSD in 2022. Each of these models represents a different philosophy of trust, one in banks, one in code, and one in math itself. This brings us to a fascinating paradox. Stablecoins were supposed to remove the need for trust, but in reality, they just redefined it. With fiat-backed coins, you have to place your faith in the companies holding the reserves, trusting that they are fully backed and audited. With crypto-backed coins, you need to have confidence that the underlying algorithms and collateral are secure and robust enough to handle market stress. And with algorithmic coins, you're relying almost entirely on belief. And as we've seen, belief alone can evaporate overnight. So even in our digital age, the fundamental search for stability still comes down to trust. The only difference is that now that trust is distributed and verified in entirely new ways. But for billions of people around the globe, stablecoins are not just some interesting experiment. They are a lifeline. In countries battling hyperinflation, where local currencies lose value by the day, stablecoins offer a crucial way to preserve wealth in a stronger currency, often without needing a traditional bank account. For freelancers and global businesses, they make international payments instant and borderless, cutting out slow, expensive intermediaries. And for investors in the crypto space, stable coins are the lifeblood of the ecosystem. They are the base currency of decentralized finance, or DeFi, providing the liquidity that keeps the entire market moving. Today, more than $200 billion worth of stablecoins circulate across multiple blockchains. They're no longer a niche tool for tech enthusiasts. They are critical global infrastructure. Of course, with that kind of explosive growth, it was only a matter of time before stablecoins caught the attention of governments and regulators. Officials around the world are now realizing that stablecoins act like privately issued digital dollars, and in some ways, they compete directly with national currencies. Some view them as a powerful force for innovation, a step forward for finance. Others see them as a potential threat to financial stability. Regulators argue that without proper oversight, a large stablecoin failure could send shockwaves through the entire system. But on the other hand, too much regulation risks strangling the very innovation that makes them so useful, potentially making them just as slow and restricted as the legacy systems they were designed to improve upon. This tension between freedom and controls what will define the next chapter in the story of money. We can't talk about the risks without mentioning the shadow of Terra. In May of 2022, the algorithmic stablecoin TerraUSD became a global headline when it dramatically lost its peg to the dollar and collapsed, wiping out over $40 billion in value, seemingly overnight. It was designed to be a masterpiece of algorithmic perfection. Instead, it became a brutal cautionary tale. Its failure was a stark reminder that financial stability cannot be created from math and code alone. Markets need real, verifiable collateral. They need radical transparency, and they demand genuine accountability. Since that event, the stablecoin industry has been forced to mature with a much stronger focus on safer, more transparent, and fully backed designs. But the memory of Terra lingers as a powerful warning. Even digital bridges can fall. Despite these challenges, the stablecoins of today are evolving into something truly transformative. Next-generation tokens like USDC and DAI, along with emerging hybrid models, are building the digital payment rails that traditional banks could only dream of. They enable instant settlement for trades, facilitate seamless cross-border commerce, and create a new kind of programmable money that can interact directly with smart contracts. For the first time in history, money isn't just a simple medium of exchange. It's becoming an API, a programmable tool that developers can build on top of. In this way, stablecoins have quietly become the essential infrastructure of Web3, the hidden engine that powers the entire world of decentralized finance. So, what does the future of stability look like? It most likely won't be a single, one-size-fits-all solution. Instead, we'll probably see a whole spectrum of different stablecoin designs coexist. Some will be fully regulated and deeply integrated with the traditional banking system, offering security and compliance. Others will remain fiercely decentralized and governed by their communities, prioritizing freedom and censorship resistance. We may even see central bank digital currencies, or CBDCs, emerge as government-controlled competitors. These would mirror stablecoin technology, but would operate without the same level of user sovereignty. The ultimate question is whether society will choose the convenience of centralized systems or the empowerment of decentralized ones. The answer will shape how money feels and functions for generations to come. Ultimately, stablecoins are not just technical inventions. They are philosophical statements. They force us to confront a question that has haunted economists for centuries. Is it possible to have both freedom and stability at the same time? For many, stablecoins represent a promising middle path, a place where the speed and efficiency of crypto meet the reliability of traditional fiat. They serve as a powerful reminder that true innovation is not always about completely replacing the old world, but about intelligently connecting it to the new one. In the end, stablecoins prove that the future of money is not purely traditional or purely digital. It's a hybrid or complex system where trust in institutions, trust in code, and trust in collateral all coexists. They are not the end of banking, nor are they the final form of cryptocurrency. They are simply the bridge between both worlds. Bridge built on code, belief, and the timeless human desire for stability. Same principles, new rails. This is the parallel economy. Thank you for watching the Parallel Economy. If you found this episode insightful, make sure to subscribe to continue learning how money and technology are evolving side by side. Hit the like button to support our work, and share this video with someone who wants to understand the real future of finance.